Section 1. How could the COVID-19 coronavirus affect my super? In today's video, we take a look at some of the important things to consider about your super during times when investment markets are affected by events such as the coronavirus. We understand news of the coronavirus pandemic and resulting share market falls could be concerning for you. Stock markets in both Australia and around the world continue to react to the changing situation. In Australia, we've seen the benchmark ASX 200 index fall more than 30% from recent highs. With all this noise and hype about the stock market, it's hard not to be getting a bit concerned about your hard-earned retirement savings. Many people across Australia are thinking, what does this mean for my super? What will happen to my super if there's a market crash? What is the correlation of super with stock markets? Why has my super decreased because of coronavirus? The answer to it is very simple. Let's look at it in depth below. When you put your money in your super account, your super fund invests that money in different assets with an aim to grow your money over a period of time. Depending on your investment strategy inside your super account, your super could have been invested in 8 types of assets. 1. Australian shares. 2. International shares. 3. Direct property. 4. Infrastructure. 5. Private equity. 6. Credit. 7. Fixed interest. 8. Cash. Your super could be invested in either one of them, or a little bit into all of them. E.g., below is the breakdown of how my super is invested and what percentage of my super is allocated in what asset. What percentage of your super is invested in shares is important. For example, if you're invested in a high growth strategy, like many young Australians, it's likely you'll have more of your super invested in shares. The more percentage of your super invested in shares, the more change in your super value you would have experienced in the last few weeks. But is this concern warranted? Should you be making changes to your super investments? Should you decrease your exposure to risky assets like shares? The answer is simple. It depends. It depends on your age and how close are you to retirement. If you're young, you shouldn't rush into changing your investment mix. Many young Australians might be considering switching their super investments to a lower risk options, particularly those who are in growth or high growth super options. But before you make any decisions, it's important to remember superannuation is a long-term game. If you're in your 20s, 30s or 40s, your super will stay invested for another 30, 40 or 50 years. So it's important not to get too caught up in short-term market movements. For others, those with 15, 25 years or more until retirement, this downturn is one of many they will experience during their working lives. For most Australians, our biggest tip would be to do nothing about their super at the moment. Market downturns, whatever their trigger, are inevitable and temporary. Every crisis, every downturn, every recession comes to an end bar none. And it's highly likely that this downturn will be no different. For example, the market falls that resulted from the October 1987 crash, tech bubble burst in 2001, September 11 terrorist attacks, and 2008 global financial crisis were all followed by a strong bounce back within a relatively short time frame. If you're close to retirement, you could reconsider your investment mix. For older Australians, it's important to remember that we all hope to live a long time. And in order for our wealth to last as long as possible, we need to maintain some exposure to growth assets such as shares. However, it's generally not a good idea to have excessive exposure to shares. A sharp downturn just prior or just after retirement can do significant damage to retirement plans. For those members who feel they may be overexposed to shares and are very worried about the impact of this downturn on their retirement, they may need to consider moving to a more conservative investment strategy. However, there are 2 things to remember. Moving to a more conservative strategy now, after markets have declined, locks in a loss of capital. And a more conservative strategy by its nature delivers lower long-term returns. And it's not likely to capture the full benefit when share markets eventually and inevitably recover. Discuss with your super company on what all investment options do they have and what can be best suited according to your age and your personal risk appetite. Now that you have understood why your super value has changed because of COVID-19, consider keeping the following 5 things in mind when analysing your super and what's happening in global markets at the moment. Number 1. Stay calm. Over time, the value of your super investment can fluctuate, depending on a range of factors, including market conditions. Reacting to short-term market conditions may mean you're missing out on subsequent market improvements. Number 2. Diversification. Most members in super funds are invested in a variety of asset classes, not just the share market. Different asset classes perform differently over time, which helps to even out the highs and lows of market volatility in a particular asset class. Number 3. Long-term investing. Super is a long-term investment, so many investment objectives focus on a 10-year period. It's expected there will be periods of volatility, but over the long term, markets may recover from short-term movements. Number 4. Stick to your plan. Understand how much risk you're comfortable with taking when it comes to how your super is invested and build this into your financial plan. You may want to consider regularly reviewing your financial plan to make sure it still reflects your current needs. For instance, if you're moving towards retirement and your super is invested in a high-growth investment strategy, your level of risk may be too high. Number 5. Seek advice. If you need assistance with determining the level of risk you're comfortable with taking on, or if your financial plan is still meeting your needs, you may wish to consider seeking the advice of a qualified financial planner. With a well-formulated plan, you may be better placed to withstand periods of volatility. Considering these 5 options with your age, you should be able to make an educated decision on what to do with your super in these volatile times. If you have any questions about today's video, or you would want us to make a video about any related topic, comment in the section below and we'll try our best to make a video on it. For more educational videos like these, click on the subscribe button so you don't miss out on any important episodes. Goodbye, and we'll see you in the next video.